this particular move may be about over and that you might have to look the other way. The other important factor about the predicted differences is to look at the whole area of where the predicted difference is relative to the zero line. In this area right here, as you can see, there's a broad area right here where the predicted differences are above the zero line, which indicates a strong or strengthening type of a trend situation. When it drops below, as it has more recently, that indicates a weakening type of situation. Of course, as it dropped below, you will also notice that in the last few days, we're going to talk about a little bit more when we look at our other chart, but when we're going to look here where we have had a crossover type of situation in the U.S. dollar, which would suggest a turn to the upside once the other indicators line up and get on board. Now, when we look at all these indicators, we have another one that we're going to bring in here and to show a little bit more detail about how to come up with some actual prices or some places where we're going to put a stop to get into a trade or out of a trade, as the case may be. And this indicator that we're going to be talking about is from Vantage Point is called the predicted high and the predicted low. We're just going to add this to this chart. It's going to make it a little bit more confusing, but we're going to cut back our time also, and we're going to talk about how we can use those to provide some signals for positioning. I want to emphasize when we're talking about all of these types of things, we are talking about a situation where we are making short-term forecasts. Very hard to say what's going to happen way out ahead. If you look out, let's say you're trying to predict the weather and you're trying to figure out, well, how many hurricanes are we going to have this hurricane season, or how much snow are we going to have next winter? Pretty difficult to do that. I know right now there's a lot of concern. Well, La Nina is possible, because of changes in ocean temperatures, and if a La Nina develops, that could mean this particular season could turn hot and dry, affecting the crops. On the other hand, it might occur late enough that it won't affect the crops. So there are a lot of types of things that nobody can figure out about weather forecasting, and I guess I would have to say that market forecasting is about as difficult to do as weather forecasting. So what we're talking about when we talk about some of these short-term indicators here is positioning and trying to play on the probabilities. It is possible, getting into the market at the right place, that you may be able to sit in a situation where you can just hang with the position for a long period of time. On the other hand, it may be such a situation that you come up with a, some kind of a signal that does point out in the opposite direction. And if that's the case, it may be a situation where all of a sudden you're going to have to get out of the market and you're going to have to determine, at that point, what is this current signal trying to tell you? What we're going to look at, as I mentioned, is our key point of entry or exit on some of these markets to get into position is the predicted high and the predicted low. Now, the predicted high that you see is the bold line or the orange line. Take your pick as to what color you want to call it. That's a predicted high, and that's predicted for the next day. As you can see here, we have right here, we have the predicted high for tomorrow, for today, actually, because I downloaded my data yesterday, but the predicted high for June 29th of 2010. So that particular indicator forecasts a day ahead, whereas the other ones, a lot of the moving averages reflect what has happened with data already in the past. So this is why the predicted highs and lows are very useful. The predicted low that you have here is that pink line or that fuchsia line that moves along the bottom, and that's very useful also for determining when to get in, when to get out if you are in a in a position already. Now, let's get to some of the potential clues that we might be able to find on this chart as to the U.S. dollar, the prospects for the U.S. dollar. I won't go through all of them because it would be more time than we have available to us to talk about each one of them, but the dollar situation generally is that we'd like to be able to trade a break of the predicted high or the predicted low. In this case, we had the market has been moving up fairly strongly. We had then a turn. The predicted differences started to turn down. The neural index went to zero. Several different clues. You had some of the, the moving averages started to get a little bit narrower in this range, right in this area, right in here. So there were some things that gave us a clue that perhaps, despite the fact that there's some long-term dollar strength going on here, that we could have a potential turn, a tradable turn that we could do in the U.S. dollar. So if we were to set up a trading strategy, we would do looking at the predicted low and say, okay, I'm going to protect myself. And again, we're assuming that in this particular move, you would have been long from some point, early in the move, going back to April, that you would have been long here, but you would have had a protective stop, and you would use then the predicted low. The predicted low right there, we would say, okay, at this point, if the indicators indicate that, some of the other indicators indicate a weakening type of situation, it is time to get short. And somewhere in this vicinity right in here, you probably, would have been able to get short the U.S. dollar index, at least for the short-term period, again, shading kind of the counter trend move against the, the longer-term move. But that's what swing traders, that's what short-term traders like to do, to be able to take advantage of those types of situations. At this point, if that being the case, as I said, we would have probably be in a situation where we would be short until now we have gotten into a situation where, as I mentioned, we have a crossover type of situation with the predicted differences. We don't have the neural index going along with us yet, but if it changes to 1, that would become a little bit more bullish. The predicted differences need to get above this 0 line, before it indicates a stronger type of move. But it's one of those markets right now that, based upon what is expected over a longer period of time, where you might want to have a buy stop somewhere above the predicted high. You can gauge that a little bit for yourself. It might be 50 pips above the predicted high. You may have other criteria that you want to use for that, but this is a situation where you can then, if you're correct and if you're using this as your short-term indicator to get in, that you can position yourself for a trade, and it could be a longer-term trade, or it could be a shorter-term trade. But it appears that the U.S. dollar could be one of the good moves in the last half of 2010. Again, this is assuming that the situation kind of stays as it is with the other currencies experiencing lots of problems, and who knows when that situation could change. That's why you need to have some flexibility, have positions in place, stops in place, to take advantage of those situations where they do change. Now we're going to go up to our other markets where I think we have some potential. We're going to not go through all the indications of where we're at and how we got where we got, but this is the euro. I mentioned the euro is kind of the mirror image of the dollar, the exact opposite of what happens in the dollar. So looking at the euro, you would expect to see where the dollar was going down, where it had its little situation where it dipped back after its rise. You would expect then that the euro probably then should